Good morning, everyone. Wonderful to be joining you today for the Global Economy Panel for Asia Briefing Live 2020, our second session for the day. I'm Alexandra Veroude, Economy Editor at Bloomberg News, and I will be guiding our panelists through our discussion today as we analyse the roadmap for the global economy out of the pandemic crisis and discuss the challenges and opportunities that this presents for our region. I'm very pleased to be joined today by Mann, Global Chief Economist at Citi, my colleague Tom Orlik, Chief Economist at Bloomberg Economics, former colleague of mine from the Reserve Bank of Australia, Owyang, who's now economist at National Australia Bank, and Adam Posen, President of the Peterson Institute for International Economics. A special thank you to our panel members that are joining us from their evening on the other side of the world. I guess it is one benefit of this new world is that you didn't have to fly the 24 hours to get here, although Sydney is very lovely in spring. I would like to make this session as interactive as possible, so I'd really like to encourage audience members to submit questions throughout our session via the submit box on the side of the screen. And I will also be asking a poll question to audience members throughout our session. Conscious of time, so let's jump straight in. Catherine, if I could start with you. Asia, like many parts of this world, is facing the greatest economic crisis since the Great Depression. We had the IMF this week that said the global economy faces an uneven recovery, albeit slightly better than initially feared. Has COVID killed the Asian century, or has it hastened its arrival? And how are the region's major economies weathering the pandemic?
Well, that's a complex question, and we could spend the entire hour on that, but let's do it really quickly. So let's start with how much variation there is around the world in terms of progress with regard to the virus. What we have done in our projections is we ask our 64 economists around the world when they think that their economies are going to get out of COVID and get back to the pre-COVID level of GDP. Our China economist and our U.S. economist have been pretty much on the same page in terms of getting their economies out of COVID and to the pre-COVID level of GDP Q3 this year for China and Q2 next year for the United States. But for the rest of the world, most of our country economists have, over the course of the last 6 to 9 months, been moving further and further out into the timetable when they think their economies are going to return to the pre-COVID level of GDP. So for the Euro area, for example, we're talking about into 2022, for Japan, well into 2022, for some economies in Latin America, even 2024. So this asymmetry in terms of returning to the pre-COVID level of GDP is a first case of fragility in terms of the return to pre-COVID or getting out of the panic for the global economy. It's particularly important for Asia, given the importance of global growth for Asia, export-led economies, that this fragility with regard to return to the pre-COVID level of GDP is a first problem. The second one, though, I think, is that when we ask our economists about pre-COVID level of GDP, it's a benchmark. It's a benchmark that says, well, you've gotten out of the hole. But of course, over that entire time period, we haven't yet made up the losses in terms of the caused by COVID, whether it be tourism in Thailand, for example, or the services sector in other countries. Now, the tech in, say, a Korea or Taiwan has done very well. But this additional differences in how countries have been experiencing COVID as for external demand, this also is a differentiator when it comes to prospects for the Asian region and also for the global economy. I guess a last dimension that we need to consider in the context of Asia is the challenges associated with trade wars, both those promulgated from the United States, but also, some that are coming out of China as well, being a concern for countries in the region. So, coming out of COVID is one thing. Getting the pre-COVID level of GDP, that's a pretty, it's an important benchmark, but it doesn't represent a victory over the pandemic in any way. And we have these other issues brewing or underway that will continue to bedevil us even after we get to on the other side of the disease itself.
Tommy, I was wondering if I could bring you in here, and I wonder if we could spend some time exploring what some of these major risks for the Asian economies look like as they do reopen to rebuild. We've had the World Bank last week saying that extreme poverty is set to rise for the first time since the Asian financial crisis. That's one terrible consequence of the pandemic. What are some other risks that you are seeing?
Yeah, that's a great question, Alexandra. So let me first of all say thank you very much to the Asia Society and to Bloomberg for hosting this event and inviting me to speak with this distinguished panel. So the COVID crisis is primarily a human tragedy, and it continues to unfold. And I don't actually think we are yet in a position to say who finally is going to come out of this strongest and who finally is going to come out of this weakest, because it's not over yet. That said, we do have some fairly strong evidence of who's managed this initial wave of infections the best, who's managed to get it under control the best. And there's a fairly clear pattern. There are some big Asian economies, China, Korea, Japan, which have managed the infection relatively well. There's some big European economies. Germany stands out, that have done it rather well and got back to work quickly. There are some other European economies, the UK, Spain, which have not managed it so well. And of course, in the United States, the case count remains extremely high. And that's really important because if you don't have your case count under control, your economy really is operating under a cloud. It's difficult to get back to full capacity. Now, when we think about the risks for Asia going forward, this is also important, because we know from our past experience of recessions that it's really the depth of the downturn which has a critical impact on the level of output going forwards. If you have a deep downturn, it's difficult to get back to the trend in activity which was in place before the recession hit. If you have a shallow downturn, it's easier. And the reason for that is, well, the deeper the downturn, the more things get broken. The more businesses go bankrupt, the more people face long-term unemployment where their skills and their labor force connections atrophy. So from that perspective, it's China and Korea which have had relative success in managing their outbreak, and so a relatively shallow downturn in 2020, which will probably face the smallest long-term loss of output going forwards.
Thanks, Tom. So our first session this morning was focused on China and the US, and I encourage anyone that missed that session to watch when it's up online. But we can't have a global panel without discussing the relations between the world's two largest economies. Adam, where do these US-China trade, technology, geopolitical tensions take us, and what does this mean for the global economy, especially given its fragile state? We had Catherine allude to that, this is a big risk for our region, but I wonder if you could spend some time talking about that.
Yeah, thank you for having me, Alexandra, and thanks to Asia Society Australia as well as Bloomberg. The news here is not good. Fundamentally, you don't need to buy into the Thucydides trap or badly founded international relations ideas about inevitable conflict. But what has happened are 3 or 4 very fundamental things. First, that the U.S. has shown political dysfunction and weakness in a way that has been coming since the global financial crisis, and arguably since Bush versus Gore in 2000. And this weakens, frankly, the deterrence effect of the U.S. and weakens its claim to leadership. The second is, of course, the election of Trump and the complete mishandling of foreign economic policy and economic policy, now COVID policy. The third, which is a long-term issue as well, is the declining support for technological openness, let's call it. Catherine probably has a better report than I do. In the U.S., that there is a sense of being under threat, and that China in particular, but in general, the U.S. political, I don't want to use the word elite, let's say elected officials and insiders, are very suspicious about technological transfer. It has echoes of what happened vis-a-vis Japan in the late 80s and early 90s, but it's far worse. And then finally, there's the sad reality, which Australia is on the front line of more US, that China has turned more authoritarian under Xi over the last few years. You put all this together, and the economic conflict comes up directly. And so looking forward, we can all hope and pray for a Biden defeat of Trump in 3 weeks. But while many things will turn around very quickly, I think, if Biden is elected, the U.S.-China relationship is not likely to be one of them, in my opinion. It's partly just the dynamic that Biden and Trump have spent the election trying, in part, to outbid each other on who was more tough on China, and it's hard to walk that back. It's partly because even Democrats, congressional Democrats, are quite worried about China and have a weird view of economics. And of course are more concerned, frankly, about human rights violations like the abuse of the Muslim Uyghurs in Hong Kong than the Republicans are. And it's partly just that Biden, like all Democratic elected presidents, tends to worry about appearing weak on foreign policy and national security. So I fear this goes forward very ideally. The biggest switch will be Biden will work better with allies like EU, Japan, Singapore, and of course Australia, and that will be more effective in constraining and encouraging Chinese behavior, and that there will be less spillover problems from U.S. picking conflicts with others. But we'll see.
Thanks, Kaixin. I wonder if I could bring you in here. Adam mentioned Australia as being one of the countries that is caught up in these disputes between US and China, sitting between their major trading partner and their longest ally. Does it get to a point where a choice has to be made on where their allegiances lie, or is this choice forced upon us as trade is increasingly impacted? We saw coal last week as the latest export caught up between the tensions.
Thanks, Alex. So I think it's clear to even a casual observer that Australia-China relations have deteriorated quite considerably over 2020. In April, Australia spearheaded that call for a probe into the origins of coronavirus. And since then, we've seen various tariffs put on goods, foreign investment blocked, Australia standing with the US to condemn China's approach to what's happening in Hong Kong and Xinjiang. And very recently, we've seen the limit of imports of Australian coal. It's really, in my view, a reflection of the global geopolitical story. I think Australia and the West are likely to remain tough on China for some time. As Adam was talking about, the politics have changed. It's clear the US is not going to reverse out of its tough on China approach. And Australia is strategically, politically aligned with the US. We have benefited greatly from trade with a booming China over the past few decades. It's clear the main narrative over the past few decades has been the rise of China and globalization, but we're really at a point in the international geopolitics where we're seeing a rebalance of economic and strategic interests, and it's likely to take years. So for Australia, in the short term, I think our exports are actually somewhat buffered by this sort of codependence over iron ore. If you think about Australian exports, about a third of them go to China. About half our iron ore goes to China. But for China, if you look at the imports of iron ore, about 2/3 of that comes from Australia. So that codependence sort of shelters the overall economic impact. But longer term, we are going to see this decoupling really take its toll on Australia. And it's something that I think will need to be in place given our strategic and political alliance.
Thanks, Kaixin. I think while we're talking about Australia, it's a good opportunity to pivot to our audience poll question. So those in the audience, if I could please have submit your answers on which country in the region represents the biggest opportunity for Australian businesses. India, Indonesia, China, Japan, or Korea? And Kaixin, while we're waiting for these poll results to come through from our audience, I was wondering where you think the biggest opportunities lie.
I think China is still just such a massive economy. For commodities, it absolutely dominates demand for like iron ore, for a lot of the energies, commodities. And the other part of our exports trade that we're looking at is agriculture and services, and we've really benefited from China's massive middle class. That said, it's clear we need to diversify. So outside of China, it's clear the strategic focus has been on India. I wouldn't think that we're going to see another China anytime soon, though. India is quite a different economy, quite a different political system. So at the moment, China is still the biggest market for us, but diversification means I think we'll look more and more at India and other Asian economies.
It's just such a giant economy. Okay, let's pivot to these poll results and see what our audience thought. And they were in line with you guys, and overwhelmingly China still seeing the greatest opportunity for Australia business moving forward. Thank you for participating, and encourage, please, people in the audience to submit questions as we're moving through. Tom, your new book, China, the Bubble That Never Pops. You make the case that China's financial system is actually more resilient than what most people think. Has the COVID pandemic changed your view on this?
Well, thanks very much for mentioning my book, Alexandra. So let's think about the biggest risk which most economists identify in China. It's a debt risk, right? China's debt to GDP ratio has risen from 150% of GDP in 2008, just before the great financial crisis, all the way up to 250% of GDP today. And when we look around the world and we scan the history books, we can't find any countries which have taken on so much debt so quickly, and countries which have taken on even approaching that level of debt have typically had some kind of financial crisis. And when we look at the details of the financial sector, if we look at the details of the borrowers, we find state-owned enterprises wasting money on excess capacity in heavy industry, real estate developers borrowing to build ghost towns in the desert, local governments borrowing to build roads to nowhere or lavish offices. So there's lots to be concerned about. But my view is that there's also some very significant sources of strength and some reasons why, even as bad loans build up in China, there isn't a trigger, there's not a tipping point for crisis. And one particular point, which I think is important and overlooked, is the very stable funding base of the Chinese banks. Because China's saving rate is so high, because the capital account is controlled, the banks can count on a steady inflow of new deposits. And that means that even as bad loans build up, the trigger for crisis isn't there. And this is a dynamic which has been vividly illustrated in 2020 during the COVID shock. If we think about what happened in the first quarter of the year, we had income for all of the biggest borrowers in China suffering a catastrophic collapse. State-owned enterprises saw profits turn to losses. Real estate developers couldn't sell any houses, and so their income dried up. Local governments couldn't sell any land, and their tax income disappeared. So all of the biggest borrowers in China's economy were at this moment where they couldn't service their loans. If there was going to be a financial crisis in China, surely it would have come at that critical moment. But it didn't come. Why was that? Well, one reason we already talked about was China was relatively effective at controlling the virus and getting the economy back to life. But another reason is because of that very, very stable funding base for the banks, which allows the banks to say to their borrowers, look, we know you're in a terrible position because of the COVID lockdown. We're going to extend forbearance. You can pay us back next quarter. You can pay us back next year when the economy has come back to life.
This recession is certainly, stemming from a different nature, this time coming from a health crisis rather than stemming from the financial sector. But while we're still on the topic of trade in China, Adam, we're seeing these trade tensions and the pandemic seemingly fast-tracking deglobalization issues. What role do you think institutions like the G20, IMF, the WTO have to play in supporting globalization, and have they been present in this crisis?
I don't think they have, but I don't think it's entirely their fault, or rather, that's unfair to the fund and the bank. They've actually done reasonably well. The G20, not so much. The issue is, just as we're finding out domestically in the US and a lot of other countries, institutions in the end are only as strong as the buy-in they have from important players. And the US was already not doing a great job of supporting these institutions and leading them, let alone leading them, already by the second term of Obama. The Trump has, of course, taken us into much worse territory. So you can go back 10 years and you can find in the first term of Obama and starting in 2010, 9 and 10 under Gordon Brown's leadership, great things being done by the G20 in reaction to crisis, really solid things being done by the IMF. And that's not as much the case now. And again, it partly goes back to China because it is partly hamstrung that the US and China are battling over some of these organizations, the WTO, the IMF, the World Bank, in part. But that wouldn't be happening if the US had done its job in terms of supporting these organizations.
Catherine, I'd like to pivot to monetary policy. We've had major central banks really providing whatever it takes approaches to supporting the economy and keeping borrowing costs low throughout this pandemic. Central banks in this region have rates at record lows. We had RBA Governor Philip Lowe this morning suggesting that the bank might be looking at purchasing bonds further out the curve. Where does monetary policy go from here? Has unconventional truly become conventional?
Well, we talk about it as new monetary policy tools as opposed to unconventional because you're right, they have become conventional. They are part of the tool chest, especially when we're at an effective lower bound. We need to be thinking about alternative tools to do the job of monetary policy. I think we have to be thinking about monetary policy and fiscal policy together at this point, because one of the hallmarks of this particular crisis, which is about the only thing good that you can say about the whole thing, is that monetary and fiscal policy really are working together to try to prevent the type of business loss, labor market scarring that Tom was mentioning in his opening remarks. Now, whether or not they're going to be effective at doing that is another matter. I think that there are two challenges that fiscal policy face and that monetary policy face. And I do have to address them together because they are so interrelated at this point, especially with regard to the role that central banks have been playing in terms of buying sovereign obligations. Not only that, but of course the private ones as well. So you can't talk about fiscal and monetary separately. So let's talk about the challenges to monetary policy first and then to fiscal policy. The challenge that monetary policy has, and this is true for all of the monetary authorities, is that the transmission mechanism of the efforts on the part of the monetary authority through the financial system and then onward to the real economy, that transmission mechanism has broken down. It broke down actually before COVID, but it's very true, and we can see it very clearly in the United States, that monetary policy accommodation has managed to elevate financial markets, whether equity market exuberance, and to very much narrow the spreads on different kinds of bond and credit instruments. This is extremely apparent in the U.S. There are other channels that we see it in terms of Europe, in terms of credit creation. So the monetary policy transmission to the financial markets is quite apparent, but from financial markets to the real economy, not so much. And we can see that in terms of, slack investment capex, except in IT. We don't see much in terms of the support for small business, for household lending, except in housing. And so that is the challenge for monetary policy. Their efforts, so to speak, are getting stuck in the financial markets rather than going on to the real economy. Now, on the fiscal side, the challenge there is how is the fiscal authority, and it's going to be different in different countries. It's certainly under discussion in Australia. Just heard from Luke Yin, and this morning as Deputy Director of Macroeconomics at the Australian Treasury, that fiscal policy has to pivot from the life preserver role appropriately played in the heat of COVID, is supporting business, supporting workers. In the Australian case, with the job keepers, the wage subsidies in order to keep the connection between business and workers throughout this crisis. That was critical at the time, but there has to be a pivot towards what I call is from the life preservers to building the better boat. In other words, we have to get through this fiscal situation and through the COVID, but we have to do so with ultimately a fiscal policy that will catalyze the private sector to get back on track with what it does, which is CapEx, productivity enhancing innovation, hiring workers. And right now, most of the fiscal positions and efforts that are put into place have not made that pivot yet. The European Recovery Fund is an effort in that direction. Some of the aspects of the Australian budget have those aspects to it. In the United States, we might see something different under a Biden presidency, with the pivot being a focus on climate. Again, the key is, what does the fiscal pivot look like that still spends money, but in a way that has high multipliers, that increases the capacity of the economy to repay the obligations that are being put out there, and that the central banks have so far been willing to buy.
We've also had like the IMF, Chair Powell, the ECB, Lagarde, in recent weeks, really urging governments to continue this fiscal spending. Really understanding the importance of this monetary fiscal union at the moment. Okay, it's time for an audience question. Question came through from the audience saying, look, globally, inflation has really taken a backseat during this crisis as the central banks throw whatever it takes to keep their economies going. We've had the Fed, the ECB, and even this morning, the RBA suggesting that they will keep rates low for some time to allow inflation to overshoot their targets. Do we see any risk that this additional money that's been created that creates an inflation outbreak? Kaixin, if I could ask you to answer that question.
Yeah, sure. Thanks, Alex. So this has become a hot topic again in markets and in policymaking circles about global reflation. We've seen this massive amount of fiscal and monetary stimulus. Catherine just talked about how that faces its own challenges. But we're seeing so much money being pumped into the system, and traditionally that's been inflationary. I think, though, what is being missed with this discussion is that that a huge amount of stimulus is proportionate to the absolute massive collapse in economic demand that we've seen as a result of this pandemic. The pandemic has been the biggest health and economic crisis since World War II. This is just unprecedented. So the fact that we're seeing this huge amount of particularly monetary stimulus, that is reflecting this collapse in demand. Monetary, as Catherine was talking about, has become less effective than it was. So the monetary response has been relatively outsized compared to what we might have seen in history. That said, yes, because of the economic weakness, we think the base case is inflation will still remain weak for some time. Where I do see some risks for inflation is actually from deglobalization. This has sort of been a theme throughout our talks, but this decoupling of China and the West, this shift to bring some of that manufacturing supply chain back home, that could see price pressures lift, and that could be a broad-based sort of inflationary pressure, more so, I think, than the fiscal and monetary stimulus that we're seeing. The road ahead for the economic recovery is going to be long and bumpy. So that kind of inflationary pressure is a while away from monetary and fiscal stimulus.
Thanks. And another audience question that's come through, which I think is really nice to ask each of you in the remaining minutes that we have left in today's session. What is the one thing that you're watching, worried about as you try and decipher the path of the economic recovery and where to from here? So perhaps if I'll ask each of you this, but perhaps Tom, if I start with you, what's the one thing you're really watching?
Sure. Well, it's a great question. I think I would echo Kaixin's point there, that once we get through the extremity of this crisis, we're going to be in a situation where central banks have pumped huge amounts of money into the economy, where they are intricately involved in providing financing for ministries of finance. And so it's difficult for them to withdraw that stimulus, and where potentially deglobalization pressures start to add pressure for prices to rise. So this is not a central case, but certainly it's a plausible risk case that we could be moving into a more inflationary environment going forwards, and it would be difficult for central banks to move aggressively to rein that in, given the close embrace they now find themselves in with ministries of finance. The other thing I'd mention briefly, and this comes back to some comments which Adam made earlier, is around US-China relations. So in a sense, I think the saving grace of US-China relations over the last 4 years has come from two factors. Firstly, President Trump's unilateral approach. President Trump has not attempted to move against China with allies in Europe and Tokyo and Seoul and elsewhere. And that's meant that whilst China has had to face a problem with the US, it hasn't had a sense of being encircled. The second thing which has been a saving grace has been the hope in Beijing that after 4 years, they might have someone else to talk to in Washington, D.C. So a risk, I think, as we look into the next 4 years, is that potentially Beijing will face a new interlocutor, potentially a President Biden, and that a President Biden would be rather better at picking up the phone to Brussels and Tokyo and Seoul and elsewhere. So China would find itself facing an implacable United States and facing a sort of encirclement by US allies. If that happens, I think that the sort of decoupling which we've all been talking about would actually start getting much more real. And I think that would have serious repercussions for growth in China and globally.
Thanks. Catherine, what keeps you up at night aside from panels in the Asian time zone?
So, I mean, the question on inflation, I really have to comment on that. We don't see a return, sort of a closing of the global output gap, if you want to call it that. We don't see that happening ever, in the sense that there's a 5 to 7% loss of GDP compared to what the trajectory was at the beginning of this year. So if we think about inflation being generated by wage demands or firms being able to pass through costs and having pricing power, you don't see that if you're in an environment where unemployment is higher than it was in January for as long as you can see. So, the story that people have in their head about Milton Friedman, the devotees of the Milton Friedman view of the world, that inflation is always and everywhere a monetary phenomenon. They've sort of didn't get the memo of the last 30 years where that has not been true. So I think that, if you're going to start worrying about inflation, you have to go out long after I will retire. Anyway, Now, what keeps me up at night, actually, there are two things. One is I am concerned that we are not going to be able to deal with the climate crisis in a manner that is effective. We can do this. There's a policy path to be able to grow and also have responsible policies to address climate change. But I fear that that requires a degree of international cooperation, which is not apparent at this moment. I am not concerned, unlike other people here, I am not concerned about deglobalization and decoupling. And the reason why is because I think firms around the world are reassessing their supply chains, reassessing those to redo globalization, maybe some more localization, but mostly a focus on diversification. So yes, they will give up some economies of scale in order to have diversified production locations, either to be closer to their customers or because of political demands. But that doesn't necessarily translate into higher prices, primarily because you have the role of IT that allows a closer communication between these diversified production locations. So again, I worry about deglobalization because it seems like it's going to be leading to higher prices, smaller markets, less variety, lower technology transfer, all the things that globalization can deliver for us and has in the past. But it doesn't have to end up that way. The trade patterns will be different, without a doubt. The trade patterns will be different, but they don't have to be lower than, they don't have to be less integrated and lower than we currently have. It's a different globalization.
It's 10 past, but I still would like to quickly hear from Kaixin and Adam, just very quickly. What are your one key thing that you're watching, Kaixin?
Sure. I think Tom and Catherine have spoken quite a bit about deglobalization. I think Catherine makes some really good points about how the end goal may not necessarily be a more terrible state of the world. But that said, I am worried about the transition period. I think it can be, the years ahead will be quite bumpy with the geopolitical environment. That amount of uncertainty about where exactly we'll end up, I think, can be quite costly. Specifically for Australia, one thing I am worried about is the long-term shift towards renewables. Australia's export sector is highly commodities geared, and it's clear for a lot of the energy commodities, this long-term shift to renewables means that those commodities are in essentially a long-term decline. I think if I can squeeze in one more thing, something I'm worried about for Australia as well, related to the borders, is that we have benefited from really strong migration for decades. That's put us in a very good position relative to other advanced economies. The borders being closed right now has seen population growth slow to the lowest we've seen in a century. We don't think that migration is going to bounce back once COVID is fixed, and we're not even sure of a fix or a vaccine. So it could be that population growth is weak for quite some time, and that's going to be quite a big drag on the way Australia has been growing for decades.
Thanks.
Thanks.
And Adam, just finally with you, very quickly, biggest risk in a word or two.
I completely agree with Catherine on inflation. I completely agree with Kaixin on migration. So to me, the real threat is that COVID reinforces a lot of trends that lead to secular stagnation, long-term, very low and declining productivity growth. And the risk aversion raised, the diminished migration, the diminished innovation, the diminished global exchange of ideas, which Catherine again mentioned, all these things, I think, reinforce excessive saving, reinforce this downward trend, and that is the defining economic problem Larry Summers rightly identified of our era.
Thank you so much. Well, we are out of time. I think we could have had this discussion on all day, but big thank you to our panel members for joining us, as I was saying, in their evenings and across the world. And thank you for our audience for submitting their fantastic questions. This has been the Global Economy panel for Asia Briefing Live. Please stay tuned for the rest of the day with a great lineup of other